Let's review chapters 4 through 7. So this first problem says Victoria Lee Company had the following adjusted trial balance, and then we need to prepare the closing entries. So we're given our adjusted trial balance and we need to go through the closing entry process. Before we take a look at the closing entries themselves, let's just talk about what we're doing with these closing entries. So the first couple steps that we will do are closing our revenues and closing our expenses. And whenever we close an account, what we are doing is we are zeroing out that account's balance. So we want our revenue accounts to have a zero balance at the end of this. We want our expense accounts to have a zero balance. So our revenues and our expenses are closed to one specific account, and that account is called income summary. This is an account that is only open during this closing entry process. So we will first close our revenues to income summary, and then we will close our expenses to income summary. Once we do that, we then would have a balance in income summary. And our third closing entry is to close our income summary to owner's capital. So what's happening there is we are taking our net income or our net loss and affecting our owner's capital by that amount, right? Either increasing owner's capital by the amount of your net income or decreasing owner's capital by the amount of your net loss. And then we have a fourth and final closing entry, and that's closing our owner's drawings to owner's capital. So you'll be decreasing your owner's capital by the amount of your owner's drawings balance. Now, we have temporary accounts and we have permanent accounts. Your temporary accounts are the accounts that are being closed: your revenues, expenses, and owner's drawings. Your permanent accounts are the accounts that will still have balances after you complete all of your closing entries. So your permanent accounts will be your assets, your liabilities, and your owner's capital. Right? Owner's capital is involved in these closing entries, but the capital account is never closed itself. Things are closed to your owner's capital, but owner's capital remains open and keeps its balance. Now let's work on the entries themselves. So our first step is to close our revenue accounts to income summary. So if we take a look at our adjusted trial balance, we can see that we had $4,300 in service revenue. And revenue, we know, has a normal credit balance. So to zero out an account that has a credit balance, we are going to have to debit our service revenue. So we will debit our service revenue and credit our income summary because we are closing our revenue account to our income summary account. And then we just take the $4,300 that we found on the adjusted trial balance. So after we complete that closing entry, our revenues are now closed. Our service revenue account now has a zero balance. And then we can move on to the next step, which is closing our expense accounts. So if we take a look at our adjusted trial balance, we have three different expense accounts. We have salaries and wages, miscellaneous, and supplies expense. Those are all normal debit balances. So to close those, we are going to need to credit our expenses. And then we are closing our expenses to income summary. So that means we will debit our income summary. Right? So we combine the closing of the expenses all into one journal entry. Right? We don't want to make separate journal entries for each individual expense account. So when we close our expenses, we're debiting income summary, crediting our expenses, we need to figure out the amounts, right? So the expenses, we just pull those from our adjusted trial balance. So salaries and wages expense, that was $1,260. Miscellaneous was $256, and supplies expense was $1,900. Now our income summary will be debited for the sum of our credits, right? Because our debits and credits have to equal in journal entries. So we add up our three different expenses, and we see that those add up to $3,416. So we'll debit income summary $3,416. Now our third step is to close income summary. And so this is where we are going to want to make a T account. So we make a T account for income summary, and we figure out what have we done so far to this income summary account, and what would its balance be after those first two closing entries. So far we have credited income summary for $4,300, and we've debited income summary for $3,416. So that means that we currently have a credit balance of $884, right? We take the $4,300 minus the $3,416 to find that balance. That $884 is your net income, because what we did was we just took our revenues of $4,300 and subtracted our total expenses of $3,416 to get that $884 number. So your balance in income summary at this point is your net income. So you could see this third closing entry be referred to as closing income summary or closing your net income. So now that we have that balance for income summary, we need to close our income summary account. So if income summary has a credit balance like it does in this case, to close it out, to get it down to a zero balance, that means that we're going to have to debit our income summary. And then where do we close income summary to? We close it to owner's capital. And we take that $884 that we just found on our T accounts. Now, why does this journal entry make sense? Well, we said that that $884 was our net income. Owner's capital increases with a credit, right? So we are increasing our owner's capital by $884, the amount of our net income. If we think about an owner's equity statement, we know that on an owner's equity statement, your net income would increase your capital. So we're just showing this now in a journal entry format, what is happening on that owner's equity statement. So after this journal entry, we now just have one last closing entry to deal with, right? And that's closing our owner's drawings to owner's capital. So we take a look over at our adjusted trial balance, and our owner's drawings have a debit balance of $550. So to close out an account that has a debit balance, you're going to have to credit that account, because we are trying to zero out the balances for our owner's drawings here. So it has a debit balance of $550. So we're going to credit owner's drawings. And where are we closing owner's drawings to? We're closing it to owner's capital. And then we just toss in the $550 from our adjusted trial balance. Now, why does this entry make sense? Well, drawings decrease your capital on that owner's equity statement. Here, we are decreasing our owner's capital by debiting that account. Right? So once again, just like in our third closing entry, we're just showing what is happening on that owner's equity statement in journal entry format. Now, we have only 4 closing entries. We close our revenues, close our expenses, close income summary, close owner's drawings. Those are the 4 that you're going to need to know. Your first, second, and fourth closing entries will always be set up in that similar way, where we debit revenues, credit income summary, debit income summary, credit expenses. And then the last one, debit owner's capital, credit owner's drawings. That third closing entry, where we're closing your income summary, that could be flipped. It all depends on the balance in income summary after your first 2 closing entries. If we were to have a net loss instead of a net income, in the case of a net loss, we would debit owner's capital and credit income summary. So that's why making that T account and being able to visualize what you have to do to income summary to close it out might be helpful for you while working through all of your closing entries. Now, problem number 2. We will need to prepare journal entries for each of these transactions, first on the books of Jones Company and then for Taylor Company. So what's happening here is on October 10th, Jones Company purchases $7,000 of merchandise from Taylor Company, FOB shipping point, terms 210 net 30. And the goods cost Taylor Company $3,000. And then, a few days later, Jones pays for the freight costs of $350 on October 12th. Then, on October 15th, damaged goods totaling $500 are returned to Taylor for credit, and the fair value of those goods were $50. And then, on October 19th, Jones pays Taylor Company in full, less the discount. So we are first going to journalize all of these transactions for Jones Company. So we have the transactions down there in the lower left that we can reference. We're first looking at October 10th. So Jones Company is buying merchandise from Taylor Company, right? So what are they getting in this case? Well, they're getting inventory. So we need to debit our inventory for $7,000. That's the amount that these goods cost Jones Company. That was the price of this inventory. Now, how did they pay for this? Well, they don't come out and say necessarily that something was on account or they used cash, but they give us these terms. So these terms, 210 net 30, means that Jones Company would get a 2% discount if they pay within 10 days, or they have to pay the net, they have to pay all of it within 30 days. So that means that they didn't pay for this inventory on October 10th, right? If we're talking about if you pay us back within 10 days, you get a discount. So whenever you see terms like this, we're dealing with accounts payable, right? Jones Company owes $7,000 right now after making this purchase. And then the next piece says that the goods cost Taylor Company $3,000. Well, when we are Jones Company, we don't care what the goods cost Taylor, right? If you go to a store and purchase something, all you care about is the price that you had to pay for it, right? The $7,000 in this case. You don't care what Target had to pay to acquire those goods. That doesn't even come into the equation for you. So the buyer doesn't care about what the goods cost the seller. That's something that we'll worry about when we're journalizing these transactions for Taylor Company. Now on October 12th, Jones pays the freight costs of $350, right? Because when it's FOB shipping point, the buyer has to pay for shipping. If it were FOB destination, then the seller would be paying for the freight costs. So whenever the buyer pays for freight, what they do is they lump those costs into the cost of acquiring the inventory. So the buyer is going to record this as an increase in inventory. They aren't necessarily getting anything extra, right? They aren't getting $350 more of inventory, but it cost an additional $350 to actually get this inventory. So they add those costs into their inventory account. Now, it tells us that Jones pays the freight costs, and whenever we see that someone pays something, we know that cash is exchanging hands. So even though the initial purchase was on account, paying for these freight costs means that Jones used cash to pay. Now, damaged goods totaling $500 are returned to Taylor for credit on October 15th. The fair value of these goods is $50. So Jones Company gets the inventory, and they realize that some of it is damaged. So they're returning it now to Taylor. When we see that it's returned for credit, that means that that's going to affect what we have to eventually pay Taylor Company. So that's why we're going to see accounts payable be decreased here. Because if you return stuff to the seller or to the store, you don't owe that money anymore, right? So we want to decrease our accounts payable in this case. Now, why is our accounts payable going down? Well, because we returned inventory, right? So our inventory is also decreasing by that 500. Now, this next piece that says that the fair value of these goods is $50. That's what Taylor Company is able to resell these damaged goods for. So think of it as they're selling it for pieces or scrap metal, something like that, right? Again, as the buyer, you don't care. You don't care what Taylor Company can resell these goods for. So the buyer does not care about the fair value of these damaged goods. So we don't have to record that at all. Now, on October 19th, we have to pay back Taylor Company. So there's a few different accounts that we're going to be using here. The first one is accounts payable. If we are paying back Taylor Company, we need to show that we don't owe Taylor Company that money anymore. So our accounts payable has to decrease. So we're debiting accounts payable. And you'll notice that we're debiting accounts payable for $6,500. And where do we get that? Well, we make a T account for accounts payable in this problem, right? So we credit accounts payable initially $7,000. And then we see on the 15th, we debited accounts payable $500. So come October 19th, if we want to decrease accounts payable the full amount, that full amount right now is only $6,500. Then we have this inventory account, that's being credited for $130. And what is that showing? Well, we paid back within 10 days, right? We made the purchase on October 10th, and we're making the payment on October 19th. So the buyer counts the discount that we're getting under inventory because it's lowering the cost of acquiring our inventory. So we will credit our inventory for the amount of the discount. Now, how do we get the $130? We need to take a look at what the terms were and what our accounts payable was in this problem. So our terms were 210 net 30, meaning we would get a 2% discount if we paid within 10 days. We paid within 10 days, so we get a 2% discount. So we take 6,500 times 2% or times 0.02, and that gives us this 130 amount. Now, the last piece, we need to show that we actually made the payment, right? So our cash is decreasing here by 6,370. And where do we get that number? Well, you owed 6,500. You got a $130 discount. So we take 6,500 minus 130, and that gives us our cash amount in this entry. Let's say you forget that line of thinking. Remember that your debits and credits have to equal, right? So our debits were 6,500, our credits were 130. We know that our two credits added up need to equal our debited account. Now, we're going to take a look at these transactions from the seller's perspective, from the perspective of Taylor Company. Some of it's going to look familiar based off of what we just saw with Jones. Some of it's completely different. So, let's start on October 10th. And Taylor Company is selling this merchandise now, right? So whenever a sale happens, from the seller's perspective, you actually have two separate journal entries that you need to record. The first one is to record the sale itself. So that's the amount of money that you charged your customer, right? The sales price amount. Then our second entry is going to be dealing with the cost of goods sold, right? What those goods that we just sold, what they had cost us to make, to buy from a wholesaler, something like that. So we're first going to record the sale itself. So we sold it with these terms, right? Which we said that was equivalent to on account. Meaning our accounts receivable has to increase by $7,000 because Jones Company owes us $7,000 now after this sale. Now, why do they owe us that $7,000? Because we made a sale. So we need to show that we made the sale by crediting our sales revenue. Then we had that cost of goods sold entry, right? So we just dealt with the $7,000 that we charged Jones Company. Now we can deal with this $3,000 that the goods had cost us initially. So we're going to debit an account called cost of goods sold. This is an expense account. So your cost of goods sold is increasing here with this $3,000 debit. And then we credit our inventory for that amount. So these two journal entries, you're going to see over and over again when a company makes a sale. So they first record what they charged their customer, right? The sales price. And then they record what that sale had cost them, the cost of those goods sold, and how much inventory they just sold. Now, on October 12th, Jones pays for the freight costs. We're Taylor Company in this case, so we don't even care that Jones is paying for the freight costs. We don't need to record that. So then we jump down to October 15th. And on October 15th, these damaged goods totaling $500 are returned to us. And then we're told that those goods have a fair value of $50. Once again, just like whenever we make a sale, we have two separate entries. when there's a return and we are the seller, there's two separate entries again. The first one is going to be dealing with this $500 amount, right? The amount that we are crediting Mac Jones Company, the amount that these damaged goods totaled. So the way that we're going to record this is debiting an account called Sales Returns and Allowances. It's a contra revenue account, so it goes against your sales revenue. So we debit sales returns and allowances for the $500 amount. And then we credit accounts receivable, because we need to show that the accounts receivable is decreasing because Jones Company doesn't owe us this money anymore. Then we have this $50 fair value, right? We're told that the fair value of these damaged goods is $50. What's that meaning to us? Well, that means that we now have inventory back in our hands worth $50. So we want to debit our inventory for $50, and we credit our cost of goods sold by $50 because we didn't actually sell those goods, right? So we need to decrease that cost of goods sold expense account. So you'll notice the entries on October 10th look somewhat similar to October 15th. On the 10th, we dealt with accounts receivable and sales revenue. On the 15th, we dealt with sales returns and allowances, which is a contra revenue, and accounts receivable. And then on the 10th, we also see that we dealt with cost of goods sold and inventory. And it's those same two accounts now on the 15th, just flipped. So your sales journal entries and your returns journal entries have a lot in common, right? Because whenever there's a return, we're pretty much just adjusting what happened with that sale. Now the 19th rolls around, and Jones is paying us in full less the discount. So what do we need to do first? Well, we show that we got the cash, we record the discount, and we show that they don't owe us money anymore. Now, when you're working through this problem and doing all these journal entries, for this last entry, what I would recommend is first starting with accounts receivable, right? Start with the piece of the total amount that they owe. And we get that $6,500 because initially it was $7,000 and then they returned $500 worth, right? So $7,000 minus $500 gets us that $6,500. Then take a look at the discount. It's a 2% discount, so we take $6,500 times 0.02 and we get that $130. And notice that the seller doesn't count the discount under inventory, but instead counts it under an account called sales discount. Then our cash is just going to be the amount that they owed minus the discount, right? So $6,500 minus $130 gets us that $6,370. Now problem number 3. We're dealing with FIFO, LIFO, and average cost now, right? So Diaz Company reports the following for the month of September. We have a beginning inventory, a couple purchases, and then we're told below that chart that there was a sale of 440 units on September 15th, and then a sale of 360 units on September 27th. So we need to work through this and figure out our ending inventory and our cost of goods sold for FIFO, LIFO, and moving average. So let's start with FIFO. So here on September 1st, we just need to show what our beginning inventory was. So we're told that we have 200 units, $5 a piece. So the total cost is $1,000, right? So we're going to put that under both the beginning inventory and the ending inventory columns. Now, September 12th, we see that we made a purchase of 400 units at $6 a piece for a total cost of $2,400. So we put that under purchases, and then we work our way over to the ending inventory column. And you'll see that we rewrite the 200 at $5 a piece for $1,000 because we still have that inventory. And then below that, we write our new inventory that just came in, the 400 units at $6 a piece. And we're going to want to keep them separate for both FIFO and LIFO because we need to know which ones came in first and which ones came in last, right? Because FIFO is first in, first out. So we need to know which units came in first. Now on September 15th, we make a sale. We make a sale of 440 units. So what we're going to do is we shift over into the cost of goods sold column. And we need to sell a total of 440 units. So if we sell a total of 440, we take a look at the first inventories listed back on September 12th. And we see that those 200 at $5 a piece, those were the first ones to come in. We need to sell all of those in order to reach the 440 unit mark. So we sell all 200 at $5 a piece. Then how many more units do we still need to sell? Well, if we're selling a total of 440, we still need to sell an additional 240 units. And so that's how we get the 240 at $6 a piece. And if you take 240 times 6, that's where you get that 1440 that you see there under the cost of goods sold column. Now for ending inventory. We'll take this step by step. Do we have any units left at $5 a piece? Well, we had 200 at $5, and then we sold all 200 units at $5. So we don't have any units left at $5. Do we have any left at $6? Well, we had 400 at $6. Then we just sold 240 of them. So that's where we see that we now have 160 units at $6 a piece. And 160 times 6 equals that 960. Now, on September 23rd, we make another purchase. So it looks pretty similar now to what we just saw on the 12th, right? We write the purchase over in the purchases column, and then we head over to the ending inventory, and we want to rewrite that we still have those 160 units at $6 a piece. And then we want to write below that we just got some new inventory in. We got 300 units. These units are at $7 each. So in our warehouse, we currently have 460 total units, right? 160 plus 300. But we want to keep them separate because they are at two different unit costs. And so when we're using FIFO and LIFO, we have to keep our inventories in separate buckets. Now, on September 27th, we made a sale of 360 units. So it's going to look like this. First in, first out. So we first sell all 160 units at $6. Then we still need to sell another 200 in order to reach our total of 360 units. So those 200 units come from the next inventory group, those at $7 a piece. So that's how we fill out the cost of goods sold column. So let's take a look at our ending inventory over here. We don't have any units left at $6 a piece because we just sold all 160 of them. but we do have some units left at $7 a piece. We had 300, we just sold 200, so that left us with 100 units remaining at $7 a piece. And you'll notice in the chart in the lower right, at the end of the month, we are left with 100 units. So that matches up. And now we can figure out our cost of goods sold and our ending inventory under FIFO. So your cost of goods sold, you're going to add up all of the total amounts in your cost of goods sold column. So we made 2 sales, right? The first sale, some units were $1,000, another was $1,440. The second sale, some units were $960, the rest was $1,400. We add all those up and we get $4,800 as our cost of goods sold. Ending inventory, that's just going to be $700. We just take that total amount from our ending inventory listed there. Now, you'll notice we didn't worry about the selling price at all, right? There's a difference between the selling price and the cost. And when we are dealing with FIFO, LIFO, average cost, we can throw the selling price out the window. That does not come into play here. If we think back to those merchandising journal entries that we just did with Jones and Taylor, FIFO, LIFO, and average cost, that's dealing with the cost of goods sold and inventory journal entries, right? We're not dealing with sales revenue. We're not dealing with accounts receivable here. So we don't care what that selling price was. That's just additional information to throw you off. When we are working on FIFO, LIFO, and average cost, we only care about the unit cost of our inventory. We care about the cost of goods sold and our inventory balances. Now, let's do this all again for LIFO, right? So FIFO is first in, first out. LIFO is last in, first out. So the first couple days are going to look exactly the same, right? The first day is just our beginning inventory. The second day is just another purchase. FIFO and LIFO split off and become different when you make a sale. So here on the 15th, when we sell 440 units, that's when things are going to look different. So let's take a look at what happens here on the 15th. Under LIFO, we take the last inventory group that just came in, and those are the first ones that we need to sell. So we need to sell 440 units here on the 15th, meaning we're going to sell all 400 units at $6 a piece, and then reach into our inventory at $5 a piece and sell 40 of those. Right? So last in, first out, we take the inventory that just came in, the last one that just came in. Now, for our ending inventory, we go piece by piece again, right? Do we have any units left at $5? Yes, we had 200 and we sold 40. So we have 160 units left at $5 a piece. Do we have any units left at $6 a piece? No, right? We had 400 and then we just sold all 400 of them. So that's how we get our ending inventory now of 160 units at $5 a piece. Now on the 23rd, we make another purchase. We purchase 300 units at $7 a piece. So we rewrite out the inventory that we had at $5 a piece, and then underneath that, we write the new units that we just purchased at $7 a piece. So you'll notice that the actual count of units that you have on each individual day is the same, no matter which method you're using. If you're using FIFO, LIFO, or moving average, doesn't matter. What changes is how we are valuing these units of inventory. Now we work on to September 27th, and on that day we sell 360 units. So how are we going to show this? Well, last in, first out, right? So the last inventory to just come in were those 300 units at $7. We're going to sell all of those. So we sell all 300 of those, and then we need to dip back into our units at $5 a piece and sell 60 of those at $5 a piece. Then our ending inventory, we see that we still have 100 left at $5 because we had 160 and we just sold 60 of them. And we don't have any units left at $7 a piece because we had 300 of those and we just sold all 300 of them. So we're left with an ending inventory here of 100 units at $5 a piece. Now, if we remember what we did with FIFO, we had 100 units at $7 a piece with FIFO, right? So once again, we're left with the same number of units. It's just a different unit cost for them. Now our cost of goods sold. Same setup. We just want to add up all of the total amounts from our sales. So 2,400 plus 200 plus 2,100 plus 300. And we see that our cost of goods sold under LIFO is $5,000. Ending inventory, we just take the 500 from our final day, right? We take the total amount from the final day, and that's our ending inventory. Now, average cost. Average cost is a little bit different compared to FIFO and LIFO. So FIFO and LIFO, we kept all of our inventories separate, right? We saw on the 12th, we had some at $5 and some at $6. On the 23rd, we had some at $5 and some at $7 in our ending inventory. Average cost, we are combining all of our inventory together into one group, and then we take an average unit cost for that inventory. So the first day is going to look exactly the same, right? Because that's just our beginning inventory. That's just what we're starting off with. Average cost differs from FIFO and LIFO once you make a purchase. So here on the 12th, we're making a purchase, and so this is where things are going to change. Let's just take a look at the purchases column right now. That's exactly the same as FIFO and LIFO. How many units you purchased at the unit cost, and then that gives us our total cost for that inventory. Your ending inventory, that's where things are different, right? Let's talk about the 600. So the first step that you're going to do here when you combine your inventories is figure out the total number of units that you have. Here, you have 600 units. How did we get that? Well, we take a look at our ending inventory on the previous day. And we see, okay, we had 200 units that day. Then we just purchased 400 more. So 200 plus 400 gets us 600. Then we figure out the total cost of our inventory, so the number after the equal sign. Back on the first, we started off with $1,000 worth of inventory. Then we just purchased $2,400 worth of inventory. So 1,000 plus 2,400 gets us that 3,400. Our last piece here is to figure out that average unit cost, right? That $5.67. Where did that come from? Well, we take the total cost of our inventory, the 3,400, and we divide it by the number of units. So we're taking 3,400 divided by 600. And if you do that, you'll end up with $5.67. Now, a check for you to make sure that you are doing it properly is that average cost has to be between the two amounts that you're averaging. So we're averaging inventory at $5 and $6. So if we got an average cost of $20, we know that something's up, right? We need that average unit cost to be somewhere between 5 and 6. So it's $5.67, so we're good to go. Now, our next day is a sale. We sell 440 units. And you'll notice, unlike FIFO and LIFO, we don't have different groups here under our cost of goods sold, right? It's all one because our inventory is all in one group. So we sell 440 units at our most recent average unit cost, and then we take 440 times that 567, and that's where we get that 2493 amount. Now our ending inventory, we just figure out how many units we have left, and our average unit cost, that $5.67, that number's only going to change with a purchase. So here, when you make a sale, it's exactly the same. So 160 at $5.67 will come out to about $907. Now on the 23rd, we make another purchase. We purchase 300 units at $7 a piece. So we come now to our ending inventory, and the first step is combining our number of units. So we take 160 plus 300 to get that 460 amount. Then we need the total amount of our inventory, the total value of our inventory. So we take the 907 and we add in this new purchase that's worth 2100. So 907 plus 2100 equals $3,007. Then defined our average unit cost. We take that total value and divide it by our number of units. So $3,007 divided by 460 gets us that $6.54. And again, we know that we are in the right ballpark because we are averaging inventory at $5.67 and $7. So it has to be somewhere between those two amounts. And our 654 is. So we can now move on to our last day here on September 27th, where we sold 360 units. So notice under the cost of goods sold column, we sell 360 at $6.54 because that's our most recent average unit cost. And then we come over to our ending inventory and we see that we have 100 units once again, right? We take the 460 that we had, subtract out the 360 that we just sold, and that's how we're left with the 100 here for our ending inventory on September 27th. Again, this average unit cost does not change with a sale. It will only change when there's a purchase. So it's 100 units at $6.54, which left us with an ending inventory of $654. So now we need to figure out our cost of goods sold and ending inventory, right? Cost of goods sold, we just add up the totals from our cost of goods sold column, and we get 4,847. Ending inventory, we just said that that was the 654 that we ended with on the 27th. Now, let's take a look at these amounts that we found and talk about what they mean, right? So FIFO, you'll notice, has the lowest cost of goods sold, but the highest ending inventory. LIFO has the highest cost of goods sold, the lowest ending inventory, and average cost is between the two. That's going to remain true as long as prices continue to increase, right? Since prices go up, these are the rules that you're going to see be followed. So FIFO, lower cost of goods sold, that means that we're going to have a higher net income, right? Because cost of goods sold is an expense. And so if we have lower expenses, our net income is going to be higher. So that sounds great, right? So why would any company be interested in this setup? Why would anyone want to choose LIFO if that meant that their cost of goods sold was going to be higher, their net income was going to be lower? It's all about the taxes, right? So if you have a lower net income, you have lower taxes. So a company might be interested in using LIFO for that reason. Now, problem number 4. We're told that Smith Company has a balance in its accounts receivable control account of $10,000 on January 1st. The subsidiary ledger contains 3 accounts. Bixler Company with a balance of $4,000, Kadire Company with a balance of $2,500, and Freeze Company, which we aren't told what the balance is. And then during January, the following receivables related transactions occurred. So we're given credit sales information, collections information, and return information for Bixler, Kadire, and Freeze. So the first thing that we need to figure out here is the January 1st balance in the Freeze Company subsidiary ledger. So on January 1st, we have the control account, which is the sum of all of the subsidiaries, right? So that's the 10,000. Bixler is 4,000, Kadire is 2,500. We can set it up like an algebra problem. So 4,000 for Bixler plus the 2,500 for Kadire plus Freeze, or plus X, equals the 10,000 that's in our accounts receivable control account. We simplify this down, and we can see that Freeze will have $3,500 in the subsidiary ledger on January 1st. So that's our first thing that we need to take care of here, is to figure out what Freeze owes us at the start of the month. Now that we know that, we can work through what happened during the month of January. So we need to figure out what's the January 31st balance in the control account. So in the accounts receivable account. Well, it started off at 10,000, and then we're told that these happened during January, right? We had some credit sales, we collected some payments, and there were some returns. But when we're talking about the control account, we're going to want to know the total amounts for each of these categories, not just the subsidiary ledger amounts. So let's add up our credit sales. So if you add up your credit sales, you get 24,500. If you add up your collections, you'll get 19,500. And if you add up your returns, that's just 3,000. So what we can do here is work through this problem. Your credit sales are going to increase your accounts receivable, right? Because that's making sales on account. So Bixler, Kadire, and Freeze all owe us more money when we make a credit sale to them. So we will add our credit sales. Collections and returns are subtracted because if you collect payment from someone, they owe you less. So we want to subtract out our collections. And if a customer returns something to us, that's going to decrease the amount that they owe. So we subtract out our returns as well. So we can start off with our January 1st balance of 10,000. add in our total credit sales of $24,500. Subtract out our collections of $19,500. Subtract out our returns of $3,000, and that's going to give us our January 31st balance. So our balance at the end of the month is going to be $12,000. If we do all of that math, that's what we end up with. So the balance at the end of the month in the control account is $12,000. Now, we need to figure out what about the balances at the end of the month for each of the subsidiaries, for Bixler, Kadir, and Freeze. So let's start with Bixler. It's the same setup. Beginning balance plus credit sales minus collections minus returns. So Bixler started with $4,000, $9,000 in credit sales, minus $8,000 in collections, minus $0 in returns. So the end of month balance for the Bixler subsidiary ledger is $5,000. So at the end of January, Bixler owes us $5,000. Now Kadir, they started off with $2,500, credit sales worth $7,000, $2,500 of collections, and $3,000 of returns, gives us an ending balance for Kadir of $4,000. And then Freeze, we figured out that their January 1st balance was $3,500, $8,500 of credit sales, $9,000 in collections. They didn't have any returns, and so they owed $3,000 at the end of the month. So you'll notice that your January 31st balances for your subsidiaries are all in that chart now, right? Bixler owes $5,000, Kadir owes $4,000, and Freeze owes $3,000. You add those up and you get $12,000. That's exactly the balance that we found for our control account for the end of the month. And it's not a coincidence, right? The sum of your subsidiaries add up to your control account. So when you add up your subsidiaries here, like we did with Bixler, Kadir, and Freeze, we need to get the same amount as what the balance in our control account would be. Now, the last problem here, dealing with special journals, right? So we're going to have a long list of transactions, and we're going to need to say which special journal does it get recorded into. So let's talk about our journals here, right? So we have a sales journal. Well, a sales journal is going to be any time that you had a sale of merchandise on account. And it's important that we remember all of the pieces here. It's not just a sale of merchandise, and it's not just a sale on account. It has to be a sale of merchandise on account. Cash receipts is any time that you receive cash. Any time that you are getting cash in a transaction, that would go into the cash receipts journal. Cash payments journal is any time that you pay cash, right? So if cash is involved, you know that you're dealing with either cash receipts or cash payments. Now, single column purchases journal, that's going to be any time that there's a purchase of merchandise on account. And again, just like how we emphasized under the sales journal, all of that must be true. It can't just be purchases of merchandise or purchases on account. It has to be purchases of merchandise on account. And then our general journal, that's going to be any adjusting entries, closing entries, or correcting entries. So we have this long list of transactions, and we need to figure out which journal they go into. So our first one here, payment of creditors on account. It's your cash payments journal because we are paying our creditors, right? So how are we going to pay them? We're going to pay them with cash. Collection on account from customers. What are we collecting? We're collecting cash, so this goes into the cash receipts journal. Sale of land for cash. So I mentioned it earlier, anytime that cash is involved, you can narrow it down into either the cash payments or the cash receipts journal. So here, even though there's the word sale, it does not go into the sales journal, right? Because cash is involved and you aren't dealing with merchandise. So here, we are receiving cash, meaning that we're going to want to put this into the cash receipts journal. The next transaction, sale of merchandise on account. Well, that's the definition of what goes into the sales journal, right? So we'll toss that one into our sales journal. Then sale of merchandise for cash. So the big difference here compared to the last one is that this isn't on account anymore. So if it's not on account, it can't be the sales journal. Instead, we are receiving cash, and so this will go into the cash receipts journal. Now, sales discount taken on goods sold. This one's a little bit tricky. So all of the other ones might have seemed a little bit upfront. This is going to go into the cash receipts journal. And why? Well, when we think back to those journal entries that we did for Taylor Company earlier in the review, when the sales discount was taken on the goods sold, we were receiving cash in that transaction. So this is part of that transaction of receiving payment from a customer. So this goes into our cash receipts journal. Now, payment of employee wages. Well, how are you going to pay your employees? You're going to pay them with cash, right? So cash payments journal. Income summary, close to owner's capital. That's one of our closing entries, and closing entries go into the general journal. Depreciation on a building. Depreciation is an adjusting entry, and we said earlier that any adjusting entries go into the general journal. Now, purchase of office supplies for cash. So once again, cash is involved here, right? So we know that it's either cash payments or cash receipts. If we are buying these office supplies, that means that we are the ones that are having to pay the cash. So that will go into your cash payments journal. And then the last one, purchase of merchandise on account. That is the definition of the single column purchases journal, right? We're purchasing merchandise and it is on account.